Corporate finance practice problem using Excel. MACRS depreciation, cash flow, and net present value problem 1. Get ready, it's time to take your chance with corporate finance. Here we are in Excel. If you have access to Excel and would like to follow along, note that we are in the practice tab as opposed to the example tab. The example tab in essence being an answer key. Information on the left-hand side, populating that information into the blue area on the right-hand side. We're going to be taking some of the things that we looked at in prior problems, putting them together in one practice problem, and then adding another component, that being the depreciation and calculation of it. So the idea being here, we're going to be putting money down. We're going to have cash flows that are going to happen from it in the future. The money that we're putting down, we're imagining on some type of fixed asset that we're putting the money in on that's going to help us to generate the future cash flows. And when that is the case, we're going to have depreciation involved. Note that although depreciation is something we do on a bookkeeping side of things for accounting purposes, it's not a cash item. So typically when we're thinking about these future flow assumptions, we're thinking about it on a tax basis and wouldn't then be computing the depreciation, but rather the money that we're putting down up front as opposed to allocating it over time when we're thinking about the decision-making process. However, the tax depreciation, as we saw in prior presentations, is important because it has a tax impact which is a cash impact on it. So therefore, we need to calculate the depreciation so that we can see what the tax impact will be. And that'll be the added component. We'll calculate the depreciation, then we'll think about our cash flow with regards to the tax impact on the depreciation. Then we'll think about our future cash flows here and do the net present value calculation discount rate at the 14%. So first we have kind of a new thing, and that's going to be the MACRS depreciation. So the depreciation will differ depending on the type of asset we have. We're not going to get into a lot of detail in terms of a depreciation or how to depreciate different types of assets. That could be a whole course in and of itself, a very in-depth topic. And of course, it can change from year to year. So for example, things like 179 depreciation deductions and special deductions are often the case, but the general idea for the depreciation then would be the MACRS types of depreciation. So we'll just give an overview of that. Again, in practice, of course, you would have to be looking at the current conditions for the depreciation and see if there's any kind of special rules on the depreciation and so on, or try to predict that into the future as well, which is quite difficult because the depreciation law could change from year to year as in terms of how much a company might be able to depreciate in 1 year, for example. But then we're going to usually take the MACRS depreciation, and that's kind of a form of a double declining balance. So we'll get the general idea of the MACRS depreciation. Note that when you are talking about taxes, the depreciation method that you must use is kind of more restrictive possibly than generally accepted accounting principles. You got to see what kind of asset you have, what category it falls into, and then follow the rules on the tax code. From a tax standpoint, usually we want to depreciate more earlier if possible so that we can delay basically the taxes, right? So if I usually want to depreciate as much as possible because for taxes, I'm trying to either reduce my taxes or delay the taxes as long as possible. So keep those in mind. We're just going to give an overview of the MACRS type of calculation here. So we're going to say that we're putting down the $900,000. It's going to be a 3-year MACRS type of asset. Again, remember you could have special depreciation 179 or special things that are applicable year to year, but here's the general rule for MACRS. Now the MACRS is, we can think about it usually as a double declining balance if you've taken normal accounting, a double declining balance, which we'll calculate here, and then a half-year convention, which means generally you would assume that the thing was purchased in the middle of the year, even if it was purchased, somewhere other than the middle of the year. In other words, the fraction of the year that it's purchased in, we will consider to be 1/2, no matter when it was purchased in actuality, is the general rule. Now, you can go to publication 946 if you want more detail here. In the table 1A, and this publication can be found on the IRS website at irs.gov, irs.gov. Type in pub or publication 946. You can find the types of property and read over a lot more detail on the rules for depreciation. They give you the rates that you can depreciate per year right here as well. So you can pull your information from there. I'm going to calculate it just so we get a better understanding. The calculation may not be exact. It's going to be about, so that we can get an estimate of what is actually happening with the MACRS depreciation. What is it doing? So let's think about that. We're going to calculate the depreciation. So I'm going to start off with the cost. There's a couple ways you could do this, by the way. I'll start off with the cost. That's going to be the 900,000. We're going to take the years then, the number of years, and this is a 3-year asset. So I'm going to say font and underline. I'm going to divide that out, and this is going to be what the straight line depreciation would be. When you think about depreciation, you typically think about it at the starting point of straight line depreciation. So it would be 300,000. Now, if I compare that to the cost, I can get the straight line rate, what the straight line rate would be. And so I'm going to say the cost was 900,000 again. Underline that, font underline. And so the rate then, the straight line rate would then be, I'll type that in here, it's going to be equal to the 300,000 divided by the 900,000, or numbers group percent, about 33.33, right? It's 33.33 on forever. Now, there's a shortcut to doing that. You could just say, instead of doing that, you could say this is equal to 1 over the amount of years that are in place, which is 3 here. So 1 over 3, 33.33. So that would be the straight line rate. Now, the MACRS is a form of double declining balance. So normally we would take that times 2 to make it double declining, and then go to the font group and underline it. And then that'll give us the depreciation cost. The depreciation cost for a year, would then be equal to. Actually, hold on a second. We're gonna take this and underline it, and this would be then the double declining rate. I'm gonna underline this. This is double declining rate, which is going to be equal to the 33.33 times 2. And so I'm going to go ahead and make that numbers group percentify it, add a couple decimals. So we're looking 66.67 about. And then if we take that times the depreciated cost, which would be like the book value, which right now, because we haven't done any depreciation yet, is still the cost. So I'm going to be picking up the 900,000. And then I'm going to underline that, font group and underline. And that would give us the double declining depreciation for a year. Double declining depreciation for a year then would be the 66.67 times that 900,000, or 600,000. Now, the tricky thing is, the thing that's really kind of confuses people a lot, is that it's a half-year convention, meaning normally, no matter when I purchase this asset within the year, I assume I purchased it in the middle of the year. So I'm going to divide it by 2 here. Going to divide it by 2 to have a half year of depreciation, and that'll give us the MACRS depreciation for year 1. MACRS depreciation for year 1, then it's going to be the 600 divided by 2, and we'll underline it here. Now the reason this is confusing is because then you might think, well, look, that's just the straight line depreciation. I could have stopped right here and I'd be done. What's the point of all this process? Well, you can do that, but in the second year, if you keep that thinking in your mind, you will be wrong, because it's not really the straight line method. It just happens to come out to the same straight line method because of the half-year convention that we took at the end of the year. So you can't really think about it as straight line, although you get to kind of like the same answer for year 1 as you would with straight line, because that'll mess you up on year 2. So for example, if we move on to year 2, we're going to have the same double declining rate here. I'll just start down here now. Make this a rate, add some decimals. And now we take the depreciated cost, or what would be like the book value at this time, which would be the 900 is what we had before, minus the prior year depreciation. And that's going to give us the 600. Let's underline that, font group and underline. And then we'll take the 66.67 times that 600. And this, notice you have to take it times the book value, and that's kind of the tricky thing. Now, there is no half-year convention here because we're not on a half year. So we just bring the 400 down. And then we're going to say, all right, the next one, same thing. It's going to be the 66.67. Make that a percent, add a couple decimals. Then the book value at this point in time, it was before 600,000. We depreciated 400,000. So we're at the 200,000 font group and underline. Multiplying this out, the 66.666 on forever times the 600,000 is the 1333333. There is no half year convention because this is an entire year, and we'll pick that up. And then the last one in double declining is usually kind of like the plug. So this year is going to be whatever it needs to be to bring us back basically to zero. So I'm going to say, what do we need to get back to where to zero? We're going to say, well, we have 200,000 minus the 1333. We need another 66.667 about to bring us to zero. I'm going to go ahead and underline that, and that'll be the total. And there we have it. Now, if I add these up, we're going to get the 900,000. So that's one way that you could basically do this. Another way that you can think about this is to use the actual rates over here on your table, which was 0.33 for year 1, 0.4445, and 0.1481. You might come up to slightly different results, especially in these upper columns, because of 1, rounding, and 2, because in these later years, sometimes they kind of adjust the double declining balance a little bit in these later years. But they're both estimates to do it, and because we're doing estimates here and projecting out into the future, this is probably going to be, a good estimate to use. You can use either the tables or here. It's a good idea to understand conceptually what the MACRS is doing, which is basically a double declining balance with a half-year convention and then some other kind of alterations to it. But also note that there also might be special depreciation, 179 depreciation, allowing you to depreciate more stuff in the beginning of the year that you got to make sure that you're taking into consideration with this kind of analysis as well. All right, so once we have that, then we can do our cash flow calculation as we kind of started off some of our beginning problems here, taking into consideration now the depreciation involved. So I'm going to say the earnings before depreciation and taxes, we're going to be picking up, I'm going to be picking that up for year 1 from the 400,000 here. I'm going to say then the depreciation is, we'll say the depreciation, I'm going to now pick up, which we just calculated. We're projecting out for year 1 to be 300,000. Underlining that, font group and underline. So we've got the earnings before taxes. Earnings before taxes equal to the 400 minus the 300. Then we're picking up the taxes. Taxes are going to be that 100,000 times the tax rate, which we're saying is 35%. 35% on the tax rate. Let's underline that, font group and underline. And that's going to give us our earnings after taxes. So earnings after taxes then being equal to the 100,000 minus the 35,000, giving us the 65,000. Then we'll add back the depreciation. So the only reason we took the depreciation into consideration with our analysis now, which we would like on a cash basis, and depreciation's not a cash basis thing, is because of the tax impact of the depreciation, which is why we're calculating the depreciation using the tax method, MACRS, instead of like what we would do for books, which wouldn't be as silly as whatever the tax does, right? We would do it in a way that makes sense from a bookkeeping standpoint rather than whatever they're doing on the tax side. So we're then going to be picking up the 300,000 and then underline that, font group and underline, and that's finally going to give us our cash flow because we're going to add that back in. And add that back in with the trusty SUM function. That's going to be the 365. Let's do it again for year 2. Why? Because it's good times. Good times doing this stuff. Year 2, we've got the money we're getting is the 300,000, and then the depreciation we had for year 2 was 400,000. So we actually have a loss. I'm going to go to the font group, underline it. Subtract that out, the 300 minus the 400. We're going to assume we get a tax benefit from the loss here. You got to be careful there too. What can you do with the loss if you actually had, a loss? Are you going to be able to take the loss and whatnot? But I'm going to say yes, we're going to get a tax benefit from the loss at the 35%. 35%, that's going to give us our 35,000. Then we'll go to the font group and underline, and we're going to take the earnings after taxes then are going to be, the earnings after taxes are going to be then the 100,000 minus the 35,000. Notice the loss here has basically a tax benefit, so the loss basically being smaller here for the earnings after the taxes. Then the depreciation we're going to add back, which is the 400,000. Underlining that by going to the font group and underline. Summing that up equals the SUM, the sum of the 65 negative and that 400 giving us the 335. Let's do it again for year 3. We're going to say year 3 is going to be equal to the inflow of the 450,000. We had the depreciation calculated over here in our table at the 133,333, underline, font group, and then underline. That's going to be equal to the 450 minus the depreciation for taxes. Then we'll pick up the tax effect on it, which is going to be that 316,667 times the tax rate, which we said was 35.35, 35%. Underline, font group, and underline. And then we'll take then the 316,667 minus that number, and that gives us the 205. The depreciation, adding it back in again. Underline, font group, underline, and then summing up equals the SUM, sum. Let's do it one more time, and then we're moving on. Move it on over, and then we're going to say the 100,000, the depreciation we calculated this time was the 6667 about, and then font group and underline, subtracting out the 500 minus that 6667 is the 433,333. Tax effect is going to be the 433,333 times the 0.35 over here, 35% on the tax rate. Underlining that, font group and underline, subtracting it out. We then have the 281. Let's add back the depreciation again, as has been our system here. Font group and then underline, and then the trusty equals sum, S-U-M. So there we have it. Now you could do the present value. So now we got our cash flow, right? And so now we want to do our present value calculation. And so we can assume that this is basically our starting point that we can think of as some of the prior problems we looked at with the net present value and the internal rate of return. And we have been calculating those like vertically, putting them up in this kind of format. But you could just continue on this table in a similar fashion and say, well, let's just calculate the net present value on this. So let's do this a couple different ways here. I'm just going to pull down the cash flow, and let's just pull down our cash flow numbers here. Just pulling that down, copying that, pasting it. So we have the same stuff, copy and paste. And then I'll total that up. Well, let's keep it as it is. And then we'll do the present value calculation for the cash flows. So the present value calculations are going to be, these are our present values, so it's going to be equal to or negative present value shift 9, the rate. I'm going to pick up the rate now on the left, this being our discount rate, which could be called our cost of capital, required rate of return. We want the net present value to clear this 14%, and it will do so if our net present value is anything over 0 at the end of our calculation here. So we'll pick up that. So we're going to say the 14% and then comma, do the comma. And then the next item, I'm going to pull my little bar down here, is the number of periods, which I'm going to pick up top. Notice once again on this vertical or horizontal fashion, which is a little different than the way we did it before, I still want to number the years with just a year in a cell so that I can copy across this formula in a similar fashion as we copied it down on the left-hand side, which we'll do again, and that'll be more familiar to our prior problem formats. Comma, comma, future value is the 365,000. Let's do it a couple more times. So we have negative present value, shift 9. I'm going to pick the rate all the way up to the left, that 14%, comma, and then we will pick up the number, which is 2 years out, comma, comma, because it's not an annuity, but present value of 1, and then the amount. So 2 years out, this 335, present value to 257,772. Let's do it again. Negative present value, shift 9, rate all the way to the left, 14%, comma. Then we want the number of periods, which is now 3, comma, comma, because it's not an annuity, and the amount. So that 339,167, present value, the 228. And then let's do it one more time. Negative present value, shift 9, rate all the way to the left is going to be the 14%, comma. Number of periods is 4, comma, comma. Future value, the amount right above it. We present value that 348,333 to 206,241. Now we could copy this across, so I'm going to delete these just to show that. If I delete these, double click on this first one. Remember that rate we picked up on the left-hand side. I don't want that to move over. I do want the numbers to move over, and I want everything else to move over. So I'm going to make this first one an absolute reference by selecting F4 on the keyboard, $ before the B and 12. Then I'm going to grab the fill handle, drag it across, and fill it in all the way across. Get that last one in there too. Don't leave it out. That wouldn't be fair. And then we'll sum it up. Equals the sum of these ones to the left. And that gives us the 1,013,116. Now we have to pick up the investment, the initial investment, which I'll represent as a negative number. Let's just type it in here, investment. It's going to be the negative 900 over here. That's what we originally put in. So we get our net present value is going to be equal to the sum of these two, underlining the 900. We're at the 113,116. So that clears the 14% because anything above 0, remember, would. So it clears it by a substantial margin at this point. We might then want to go further and say, well, what would be the internal rate of return? And you can calculate the actual IRR here. But we'll stop it there for now. I just want to recalculate the net present value as we have seen it in the past, because sometimes you'll see it in this format, in a horizontal, sometimes vertical. You want to be able to set it up either way that makes most sense to you and be able to understand whenever you see someone else set it up in some way that's weird. You set it up weird, backwards way. That's not how I see it, but I see how you did it. So we'll just say 1, 2, 3, and then select those and drag that down and put this in our horizontal fashion. And then we're going to go alignment center, and then we'll pick up the negative 900,000. And then we're going to pick up our inflows, which were we calculated them down here. So it's going to be this amount plus year 2, the 335, plus year 3, which was the 339, plus year 4, 348, 133, or 348, 333. So the total, and I'm going to sum this up this time, font group and sum, equals the SUM of these items. This would be the flow if we didn't have then the time value of money calculations. Then I'll do the time value of money a lot more quickly here because this is the format we've seen in the past. Negative present value, shift 9, rate all the way over to the left, 14%, F4 on the keyboard, making an absolute $ before the B and 12, comma, number of periods is that 0, comma, comma, future value, the 900. Let's go ahead and Control C that one, copy it. Go down, hold down shift, scrolling down, Control V there, pasting. And then go to the font group and underline and sum it up. SUM. And there we have it. So we got the same calculation in this kind of vertical fashion as well, which is the way I tend to do it. But again, if you work your table right here, you can do this horizontal calculation. You'll often see it just kind of built in to the table. You might as well just keep on rolling on down until you get to your net present value in one kind of worksheet. Or you can basically, do it over here in a separate calculation, whatever you want to do, and it's okay. And you can see it multiple different ways and whatnot.